We make light of it being partly February in New York. It is a serious issue, as we've learned, from North Dakota on down to Texas, on the edge of the maelstrom of the Midwest. James Bianco with us, Bianco Research, this morning. Jim Bianco, real simple. Does the carnage of the Midwest deep freeze, does that adjust national economics?
You know, you'd normally think it would, but given that we're already in the mode of working from home, the impact is far less than it would have been in a pre-pandemic era. So a lot of people like me are at home working, and while it's snowing outside as I talk to you, not a whole lot is going to change with my work habits just because of the pandemic.
Jim, many people missed the recovery last year and how quickly, more specifically, how quickly the US would recover. Are we doing that all over again?
As far as missing it, no, because I think a lot of people are expecting a booming recovery. If there's anything, we might be missing the return of inflation. I've heard that, Wall Street has been upping their forecast for real GDP growth. And I would just put a little finer tune on that and say, maybe it turns out to be nominal GDP growth that's going to go up, and that more of that component is going to be inflation and a little less of that component is going to be real growth. But I don't think that there's a lot of people that are looking for the economy to turn south anytime soon unless something comes along to break it.
Markets are picking up on that. It feels like economists are behind the curve, though, on this, Jim. You speak to many market participants and economists separately. It just feels like the economists haven't quite upgraded their forecasts yet in the same way this market has, particularly in the bond market.
Yeah, I think what they're being influenced by is interest rates. They're heading higher, and I think they're going to continue to head higher. But it's been a gradual grind. And so when I talk about the potential of inflation coming, I understand there's a base effect. But then after that, and rates might continue to move higher on inflation, the answer or the question is, why aren't they going up now? You've got the Federal Reserve buying $1.5 trillion of bonds a year, and that's probably dampening the type of move we would have X them as well. But I do think it's there, and I think that they're just economists are starting to pick up on this idea that, as Dennis Gartman said in the last hour, the super cycle has turned, commodities are moving higher, and inflation looks like something that is coming back that we haven't seen in about 30 years. So it's also something that's very new for a lot of people.
That's actually what I was going to say, that there's been a conditioning over the years that just because the Federal Reserve is incredibly involved in markets doesn't necessarily mean that we're going to get higher inflation. I am wondering, and not to harp on this, but good inflation versus bad inflation. If the goods that you buy and everyone is buying more of them and no services or not as many services during the pandemic, and those goods are getting more expensive because of the increased demand, so the real inflation is going up faster than perhaps some of the headline gauges. Is that good? Do wages necessarily follow? What's your sense?
Well, two things. On the goods inflation, you're not seeing it as much in the data, but Matt Iglesias brought up a good point on Twitter over the weekend. You're getting rationing. Go buy something at Home Depot or Lowe's, and the price is cheap, and you'll get it in April. So they're rationing out their supply as opposed to raising their prices. Well, that's a form of inflation. It's just not showing up in the data as well, too. As far as where we're going to go from here, I think, when you talk about bad inflation, the question is going to be, once we reopen with all the stimulus and services start to move, because a lot of them are dormant right now because of the lockdown restrictions, are we going to see that start to move? And finally, you mentioned about wages. We have already been, the vernacular I've been using, we've been mailing people money. We just got done mailing them $600. We're going to mail them $1,400. I understand why we're doing it. That's 20% of the American income right now is being sent to you via the government in the form of stimulus. And there's another big one coming. Don't need wage inflation. You have personal income inflation because the government is making up that difference. And that's going to lead to a big stimulus when things reopen later this year.
And this is the big distinction that people are pointing to of why we're going to get inflation that's much faster than people are expecting. As economists become more accepting of this idea, how high can yields go?
Well, that is the concern, because we have a deeply negative real yield right now. If you were to get inflation back to, the Fed says that they'll tolerate 2.5%. Okay, fine, let's use that. And then people believe that inflation is something to stick with, we might have to move to positive yields. That could get you at least to 2.5% on the 10-year note. I mean, over a long period of time, like the end of next year. And in this levered bond market, that kind of move would be very unsettling, even though you might look at it from a long history and say it's still 2.5%, it's a very low yield. But from the perspective of the way that bonds are traded and held, and especially financed through the repo market, that kind of move in yields will be a very difficult one for everybody to swallow.
Jim, I want you to go back to your training in technical analysis. You are a CMT. How do you find the breaking of trend on the real yield?
The real yield breaking of trend is going to be very difficult to find right now because it's been in a downtrend and it really hasn't turned very much. But what I have found in looking at those charts is when it does break, it tends to move rapidly. Quickly.
Yes.
I heard John say, maybe there's a little bit of a turn here, and that's an accurate description. And then there's a little bit more of a turn, and then pow, it just goes.
Okay, well,
that's really what people are most worried about when it comes to real yields. There won't be this gradual rise like you have with nominal yields. They could move a lot faster.
Yeah, what's important here, Jim, is red zone, green zone. So your experience here on 2-10 spread or real yield is when you go boom, you go. Is boom right to a positive statistic?
Now, I don't think it'll be to a positive statistic right away because there's a long way to go. It's almost 100 basis points. But it will definitely break the downtrend that we've been in. And it'll also be unsettling because remember, who's the biggest buyer of real yields is the Federal Reserve. They own 20% of that market right now, and they're buying it aggressively every day. And if that move starts in the face of all that Fed buying, you start thinking, what's the private sector doing in that market? Selling aggressively, and that will be further unsettling for everybody.
Jim, just final one. You watching that hearing later?
Yeah, I'm going to watch the hearing. Unfortunately, I think they're missing the point. It seems like it's going to be about justifying short sale instead of some of the things that have gone on. It's going to be theater, but I don't know if it's going to have much substance.
Jim, isn't that always the way? Good to see you, sir.
Yep.
Jim Bianco, Bianco Research founder and president from New York City this morning. Good morning. Equity futures down.